To trade stocks, every trader must understand technical analysis, which uses past trading activity and price changes to identify future trading opportunities. The tools used for this are called technical indicators. Each technical indicator will fall into one of these four categories, such as momentum, volatility, volume, and trend, which will be considered either a lagging or leading indicator. When paired with proper risk management, these can help you gain more market insight. They are used to help identify short-term and long-term trade signals. Let us help you find an indicator that will fit your trading journey. 5, 4, 3, 2, 1. Let's invest. Indicator 1, price action. One of the best indicators to use for trading is price action. You may not see this as a tool, but as a data source. However, it will be the only information giving on a bear currency chart, meaning it's essential to incorporate into building your strategy. If you plan on being a trend trader, working closely with price action may be best for your overall trading growth. Price action can be used by analyzing trends, identifying entries, and exit points. Based on chart patterns and candlestick patterns, they have the potential to help you plot the next reversal or breakout to trade. There are two ways to use these predictions by identifying the direction and volume. Indicator 2, moving averages. The abbreviation MA stands for moving average. It's an indicator that identifies price trend average over a particular period of chosen time, by combining price points then dividing it by a number of date points, presenting a single trend line without the short-term spikes. There are three different forms of moving averages: simple, exponential, and weighted. Simple moving average. The simple moving average can also be called the SMA. It's most commonly used out of the three. It calculates each day of the average price over a specific number of days. Once the new trading day starts, the last price is moved to the old set of dates, then acts as the most recent. They represent a true average of prices for the entire time period, making them the best indicator to identify support or resistance level. If you're interested in short-term trends and trades, try a moving average between 5 and 20 periods. If you're interested in medium-term trend and trades, try a longer moving average that might extend 20 minutes 60 periods. If you're interested in long-term trends and trades, try moving averages with 100 or more periods. Exponential moving average. The exponential moving average can also be called the EMA, is the start for put emphasis on the latest prices. They have the more recent data which will be weighted more heavily, but will lag less than in simple moving average. Therefore, they are more sensitive to recent prices and recent price changes, resulting in them turning before simple moving averages. Weighted moving average. Weighted moving average are similar to the exponential moving average. It prioritizes the latest prices rather than the earlier data over a specific period of time. However, it assigns weight to the latest price. If price travels above the line, it means buyers are controlling the price. Then, if price travels below the line, it means sellers are controlling the price. Knowing this will help you identify support and resistance level with the chart. Just like any indicator, the moving average is a lagging indicator, meaning it calculates the historical data, not predicts the future direction. The higher and longer the moving average, the more lag. You're placing trades as an educated guess from the data sources. Indicator 3, Relative Strength Index. Relative Strength Index is a technical indicator that shows momentum from the closing prices in the market as temporary, through being overbought or oversold. When calculated, the chart displays an oscillator, which is a line between two extreme values of 0 and 100. However, many use the values of 70 and 30, which is different from the normal. You have to find the best methods that work best for you. The values 80 and 20 have been used to read the market conditions. When the line moves above the 70, it may indicate a trend reversal. Then, when the line is below the 30, it may indicate a breakout. The default day time frame is 14. Indicator 4, Stochastic Oscillator. The stochastic oscillator is a momentum and leading indicator ranging from 0 and 100 that shows location of the close relative to the high-low range over a set number of periods. This indicator consists of two lines, one for reflecting the actual value of each session and the other for reflecting the 3-day simple moving average. Since price is thought as follow momentum, when they cross it can be a signal for a reversal. The fast oscillator is %K in moving average. The 3-period moving average of K is referred to as %D. Indicator 5, Bollinger Bands. Bollinger Bands are used to measure markets' volatility and market conditions, such as overbought and oversold. The band consists of 3 lines, upper, middle, and lower, that automatically adjust to the changes of the market. When the bands widens, price volatility is increased, and when tightened, volatility declines. Indicator 6, Parabolic Stop and Reverse. The actual indicator used in charts is SAR, which stands for Stop and Reverse, meaning it trails price as the trend extends over time. The indicator goes below price as it's rising and above prices as it's falling. In retrospect, the indicator stops and reverses when the price trend reverses and breaks above and below the indicator. When a dot is below the price, it indicates a bullish signal. Then, a dot above the price shows that the bears are in control and that the momentum may remain downward. When the dots reverse, it indicates that a potential change in price direction will take place. Indicator 7, average true range. The average true range measures the particular number of price bars, a pure volatility identifying the high and low periods in the markets. The high volatility shows a market with ongoing price fluctuation, whereas low volatility shows a market with little price activity. This will help you buy and sell signals. Indicator 8, on balance volume. On balance volume, calculate the buying and selling pressure, which sums you the volume on up days and subtracts volume on down days. When the security closes higher than the previous close, all of the day's volume is considered up volume. When the security closes lower than the previous close, all of the day's volume is considered down volume. These indicators are more directed towards active traders for short-term price movements. They can be seen as little value to long-term investors. There are many different options. However, you must select the best indicator and learn how it operates. We hope you find our videos very informative and useful along your trader journey.